Hey, good morning, everyone, and welcome to our monthly National Trends webinar, where this month we're going to focus on the big question of, is a recession going to wreck the housing market? Obviously, a very loaded question with lots of data points, variables, and a lot of historical stuff we can look at. So we got a lot of great data here that YourCast Real Estate and JPAR have put together. We'll go through the slide deck on here. So be ready for data. If you have any questions to go through, please post in the chat. We are monitoring them, and we love questions from investors. We love questions from agents. So interact. Please ask us questions. And most importantly, I've got an expert panel here to help us go through some data. Again, my name is Chris Lopez. I'm an investor-friendly realtor here in Colorado, and I also work with Iron Capital. And I've got Joe Massey, who's a great lender at Castle and Cooke, and knows quite a few things about interest rates and also a bunch of data. Joe, always got to have you back in the studio.
Yeah, great to be here. Appreciate you guys having me on as always. Love talking about this stuff. I know Lon put a bunch of time in putting this stuff together. He and I have gone through it a number of times and just excited to chat about it.
Yes, and Lon Walsh will be joining us hopefully a little bit later in the webinar. He had some plane travel plans get delayed, so he'll join us if he can when the plane lands. Next is Zach Garfias in the white shirt there, who's Iron Capital. Zach, what's up? Good morning.
Hey, good morning, Chris.
Glad to have you here. And, of course, Nick Elder with Iron Capital as well. Help us answer questions and give us some great insight. And, Nick, I know you walked some properties last couple of days. Yeah. So you're going to have some on-the-ground knowledge to share with us as well.
Yeah, they were great properties. Look forward to discussing those.
So getting into national trends here, Joe, I mean, this question, you're talking with realtors and investors and traditional home buyers all the time. You're on the front lines talking with people and helping them, advise them what to do, and also creating a lot of content. So when you hear the question that everyone's asking, is a recession going to drop the market? Where do you start?
Well, that's a really good question. The short answer is no. A recession is not going to drop the market.
So webinar over?
That's it. We'll see you guys next month. But let's go to the next slide, and I'll show you some of the things why people think this, or why people think the recession is going to really cause a lot of problems. 67% of Americans say the housing market crash is imminent in the next 3 years. All right, let's think about that for a second. 2/3 of people think that there's going to be a housing crash. Now, we're going to look at a lot of data, a lot of stats that are going to show you there's not likely to be a housing crash, but the perception out there is, holy cow, the world is about to end. Guess what? It's probably not, all right? The world is not going to end, and I think there's going to be a lot of opportunities for folks, but I can see why consumers are so gloomy. Look at affordability, all right? So this graph here shows affordability rated on a scale from 60 to 150, and the higher that number, the more affordable homes are. So let's go back to the far left and look at 1997 and then all the way over until like 2007, early 2008. Homes were really affordable, and this is when prices were really, really low. But you see affordability starts to go down in 2003 to 2007. Well, what caused that? We saw a big run-up in prices. And then all of a sudden, 2008, you get a global financial crisis. And what happens to home prices? They go way, way down. Well, home prices and affordability work opposite of one another. So when home prices go down in 2008, home affordability goes way, way up all the way into 2013.
So that's that big 45-degree angle basically saying.
Yeah. You see home values go down. Therefore, homes become more affordable. Also, you saw during that time period, interest rates went down. Well, then you look at 2013 and you see it becomes a little bit more difficult to afford a home. Why? Home prices started going up. All right. You guys remember coming out of the 2008, 9, 10, 11, 12 crisis, home prices began to increase. And then you see it becomes more and more difficult to afford a home. But all the way over through the little COVID bounce there, and you look at the peak in 2020, home prices were way up, but interest rates were way down, making it very, very affordable. And then you see on the far right, it falls off of a cliff. We go from the really increased affordability of like 135 all the way down to 65. Any guesses on what led to that?
My guess is the massive price appreciation with this unprecedented interest rate increase.
That's exactly right. You combine those two things and homes become less affordable. And the third thing to throw in there is increasing wages, or in this case, non-increasing wages, right? If the median income doesn't go up to keep up with that, it becomes more and more difficult to afford a home, okay? But that's why consumers feel really, really gloomy, is because in their point of view, it's really difficult to buy a home.
Well, and something else here is a lot of this too is, is the data and also just the perception. The headlines are just been kind of depressing. Actually, the last couple of years, last 6 months have been really depressing as far as the economy goes. So this is where we're going to go through the data, but also understand this is the consumer sentiment out there. We're all kind of unhappy. So please ask questions out here, and agents. I know a lot of agents on here. Please ask any questions that you want to clarify and help you better explain your clients. We want to make sure that we just give you the data, but we give you the context of the data to properly interpret it and make the best decision for you and your clients, which is something you're so good at, Joe,
Thanks.
Dissecting it down.
I appreciate that. So the next slide here, are prices going to drop? Well, if you're on the western side of the United States, the answer to that is yes, prices have dropped and may continue to drop. If you're on the eastern side of the United States, prices have not dropped. But there's more to it than that. So looking at this chart, there's almost a line right down the middle of the United States, with the exception of Austin, which is just on the other side of that line. But the western side of the U.S., California has had decreases of 10%, 3%, 6%. In Denver, we've seen flattening of prices, and the median is down 1.7%. Does that mean that the market's crashing if we've had a decrease of 1.7%? No, it doesn't. All right. But look on the eastern side of the U.S., you've seen prices increase over the last 12 months, 5%, 6%, 6.8%. And so nationally, there has not been this drop of 25% or 20% or even 5%. All right. So if you're on the western side of the U.S., you probably have a pretty pessimistic view. If you're on the eastern side of the U.S., you probably have a little bit of a more optimistic view. And so that's really important to understand. Go to the next slide. What's led to that is home price appreciation over the last 20 years. All right. On the western side of the United States, we've seen massive, massive appreciation, 300%, 500%, 574% in Colorado. But look at the eastern side of the United States, 198% in Ohio, 272% in West Virginia. This is over a 20-year period. All right. So the increase of interest rates has adversely affected the western half of the United States versus the eastern half of the United States. The reason that is the western half of the United States, it's more expensive. It just is. It's more expensive in California. It's more expensive in Las Vegas, Arizona, Colorado than in North Carolina, South Carolina, Georgia. All right. So when interest rates increase, you get a disparate impact that it impacts folks on the western half of the U.S. more than the eastern half of the U.S. All right. So the forecast for 2023 national home appreciation, these forecasts have gone down versus when we put these slides together 6 months ago. But nobody is expecting a crash like 2007, 2008. So you can see on the far left side, you've got some folks that are a little more optimistic. They think there's going to be increases of 2.6, 0.3, or 0.7%, all the way to folks on the right-hand side, Moody's, Morgan Stanley, Wells Fargo. They think national prices are going to decrease anywhere from 5 to 10, maybe even 3%. So I want to take a little informal poll. What do the three of you think? Where would you land on this chart for what's going to happen to national home prices over the next 12 months?
Well, first, I'm terrified of making a national trends prediction because it is very local.
I agree.
And Denver versus Oklahoma versus Washington, D.C. are all very different markets. For Colorado, where I know, I think we'll be flat up some for next year or so. National, I'm gonna bite my tongue because I have no idea.
Yeah, it was interesting. Whenever a couple months ago, I went to that Vectra Bank Forecast Summit, and they actually anticipated in 2024 having 1.7% GDP growth in the economy. And so, assuming maybe that's the case, I'm thinking we'll probably be flat in 2023, but in 2024. If the government finally says, hey, yes, we're in a recession, I wish they would just kind of say it sometimes, whether we're there or not. But if they do say that, I think that's when the rates will probably come back down, and then that can really change.
Well, no recession 2 years after the fact.
It's always retroactive.
Right.
It's like, oh, by the way,
right.
it started, in 2022.
This is very interesting with huge price appreciation, even with some of it coming down. It's been an amazing ride.
Yeah. Yep. Now, what's supporting prices? All right. We've had interest rates going up. We've got 67% of people that think there's going to be a housing crash. Wouldn't that lead to prices beginning to decline? One would think so, but that's not what we're seeing. And one of the reasons is, or one of the big reasons, is lack of resale homes on the market. All right, so newly listed homes, this chart on the left, if you look at the very bottom, we've had 312,000 homes listed as of February of 2023. That is a record low for the last 6 years. All right, we have fewer homes listed for resale than ever in the past 6 years. All right, and on the right-hand side, number of new listings is down 25% as compared to back during 2017 to 2019. Now, why do you guys think that is? Why do you think there's fewer listings than we've had historically?
Well, everyone's got their rate locked in.
Yeah,
that's right. I have one of my
absolutely.
favorite memes right now is that meme of the aristocrat looking down, on the peasants below them.
Right.
And so I'm like, oh, I'm locked into my 2.6% interest rate. Why would I ever sell and get rid of it?
That's exactly right. That's exactly right. So what we're seeing, if you go to the next slide, is the number of homes for sale is increasing as compared to last year, but we are still well behind where we were at in 2017, 18, and 19. So go one more slide right there. Look at this. You had a dip of the number of homes listed in 2021 and 2022. It's increasing, right? So the headline from 2022 to 2023 is, oh, listings are up by, 60%. There's going to be a housing crash. Well, that's not entirely accurate if you look at the historical data that we're still well below 50% of a normal market such as 17, 18, and 19.
Wow.
There's just not enough homes for sale.
Yeah.
All right.
It's not enough homes, period, too.
Right.
Which I think is covered in a future slide.
Yep. And this is what you just touched on. Where are all the sellers? This slide on the bottom right, I really like this slide. 50% of mortgages in the United States were originated within the last 3 years.
Wow.
All right.
Whoa.
So think about that.
Wait, what?
50% of people that have a loan on their home got that loan within the last 3 years.
Like this is for purchases and refis?
For purchases and refis.
Wow.
50% of the mortgage market, that little dashed line on the far right there, it's the right-hand chart, yep, right there. That is where 50% of home loans have been originated in the past 3 years. That means they're likely at rates of 4% or less. All right. If I've got a 2, 3, or 4% mortgage and I'm going to sell and buy something at 6%, maybe that doesn't seem that appealing.
Right.
So I might be locked into my home for a period of time because I really like the preferred financing terms that I've got.
Yeah, well, I mean, everyone generally wants to be a trade-up buyer. Like, you buy a house, traditionally start a home, and then trade up as your equity builds, your income grows, and then, hey, buying a more expensive house at twice interest rates is hard on the payment for a lot of people.
Yeah, that's exactly right.
Yeah.
So there's not a ton of resale sellers. What about new builds? All right. This is a gigantic supply problem that we've got. So the average annual units that are built in the United States over the last 50 years is that gray line in the middle. We've been building an average of 1 million new homes per year over the last 50 years. And that the purple bars there, that is everything prior to the 2007 and 2008 financial crisis. And what you see is in 2006 and 7, there was 1.6, 1.2 million homes built. And all of a sudden, that falls down to 800,000, 400,000, 300,000. And over the last 15 years, we have not built that average 1 million homes that we need. All right. So the population is still growing. People are still having babies. People are immigrating. People are moving. Population and households are growing, but we are 4.5 million homes behind in new build construction. All right. Is that a big number? What do you guys think?
That's huge.
Yeah.
Yeah. And it's really telling to see this because it's such a drastic drop from 2008 to, I mean, we're so below the average come post 2008, 2009.
Mm-hmm.
And even as we've increased, like it's still nowhere even near the average. And so it's really telling to go back, 12 years at this point and see where it all began. The housing shortage really began.
Yeah.
I think it's a very telling chart.
Yeah, that's exactly right. And so having that many homes missing means that new builds are not going to solve the problem anytime soon. We basically need 14 years of being above average just to get caught up, okay? Just to get caught up. So it's going to be very, very difficult for us to get out of this housing shortage. Now, this is one of my favorites. So millennials, these folks are in their peak home buying years, folks that are age 20 to 35 or almost 40 years old. This is the largest demographic cohort in the United States right now. It's bigger than Gen X, bigger than the baby boomers, and these are all people that are in their peak home buying years. Mm-hmm. So think back, folks that are on the call, maybe you're a young person, maybe you're an older person, but think about being 25 or 30. And what was a common goal when you're 25 or 30? There's usually three: get married, have kids, buy a house.
Yeah.
Right? Maybe not in that order. Maybe buy a house, get married, have kids. Who knows? But a lot of those folks have that goal of buying a home. Well, guess what's not out there from the last couple slides? There's no new builds. Let me rephrase. There's few new builds.
And the ones that are the upper price points. They're not starter homes.
Yeah.
That's right. Which I can go down a big rabbit hole on why that is, but we won't do that today. There's fewer new builds to buy, and there's fewer resale properties because everybody that's got a property to sell has a really, really good interest rate, and they probably don't want to sell unless they've had a life change, right? They're retiring, they want to be an empty nester, et cetera. So what do you guys think about, let me put you two on the spot. You guys are young folks.
Yeah.
Is it difficult to buy a home as a millennial right now?
Yes.
Why?
Well, interest rate payments and the price of homes. Yeah, interest rate payments and the price of homes, and ultimately a lack of inventory.
Mm-hmm. That's right, because you've got 10 other people that want to buy the same house.
Right.
Yep.
There's only 2 houses for sale, and it's really expensive, and somebody over here has somebody with a huge down payment.
Right.
Right? So it can be a real, real challenge. And for everybody on the call, the reason this is important is this means that prices are not going to drop, right? There's not enough supply, too much demand, even with high interest rates, that pushes up prices, all right? Or at least keeps prices flat while interest rates are really high.
Yeah. And even here in Denver, I mean, we don't have a slide for this, but, Colorado, our seasonality-wise, this springtime is like our busiest time, the most time we get bids, and we see the most price appreciation. February, March, April, May is our peak time. And I mean, 2 months ago, 6 weeks ago, man, things have really heated up.
Yep.
Where we're seeing multiple offers.
Yeah.
I'm sure you're seeing. I mean, I'm on the brokerage side. You're on the lending side, Joe. You're seeing the same thing, right?
Yep. February 15th every year. That's when the spring market takes off in Denver anymore.
Yeah.
Used to be like April 15th, but it's been gradually inching early. February.
Well, during
15th.
COVID, it was like January 1 for like 1 year.
Yeah.
I would love to hear in the comments here, because we got people in all sorts of markets, many more markets than I thought. What are you guys seeing out there for competition? Because right now we're seeing overall multiple bids, if the property is priced appropriately and all that.
Yeah.
If the seller and the agent have realistic market expectations, we're seeing multiple offers for the most part.
Yeah, I see a tale of 2 housing markets. All right. You have somebody that's well represented, that understands the market, that lists their property at an appropriate price, and it goes under contract within the first weekend for maybe $3,000 or $5,000, maybe $20,000 above list price. That's one housing market that I see. The other housing market that I see is somebody that has an overzealous seller or maybe an overzealous listing agent, and they're saying, hey, prices have been running up 20%, so we're going to list your house 20% higher than the last year's comps because that's what the market shows us. They list that property, and then it sits for 30, 60, 90 days. I see one or the other. I don't see anything that's on the market 25 days at an appropriate price. It's either listed appropriately, it goes quickly, and everybody's happy, or it's listed way too high and it sits forever and everybody's mad at one another.
Yeah. So two big takeaways here. Agents, if you're an agent on this webinar, listen to what Joe said and rewind that and make sure you price it appropriately. This has been, the data has shown this for years, as long as I've been an agent.
Yep.
And if you're an investor out there, guess which type of property you should be going after to maybe find somewhat of a deal. Go for the overpriced stale listings. We've seen some better opportunities with that as well. So if you're a listing agent, make sure you price appropriately. If you're an investor, look for the overpriced stale stuff.
And it's there. A lot of times people tell me there's no deals on the market. Well, I've been hearing that since 2012. I promise you there's deals out there. All right. Will there be a foreclosure boom? This is one of my favorite questions. So this is lending standards. So the housing bubble. So this chart rates how easy or difficult it is to get a loan on a scale of 0 to 1,000. And during the 2007 housing bubble, it became really, really easy to get a new loan. All right. And you see it peaked at 868, meaning that is very, very loose credit standards. It was really easy to get loans back then. And then 2007-8 arrives and you see it just fall off a cliff and it goes down to about 110. And then it kind of bounces around from, 100, 95, then gets up to almost 200 in, middle of 2019, where it became a little bit easier to get a loan. COVID occurs and everybody freaks out. And now today, lending standards are rated at 100.1, meaning it's pretty difficult to get a loan right now.
Yeah.
All right. Part of that is regulatory based. Part of that is affordability. Part of that is interest rates that it's more difficult for some people to qualify for. But the big thing that we want to talk about here is that is not going to lead to a foreclosure crisis, because everybody that's getting a loan likely has the ability to pay for that loan.
Yeah.
All right. If you verify your paychecks, your income, your bank statements, you put a 20% down payment, pretty likely you're going to make the payments, versus if you go back and look at 2006 and 7, we had some folks that were very, very marginally qualified, and we gave them $500,000 loans. What do you know? If you don't verify all that information, they might not be able to make the payments. So we're not going to have a big foreclosure crisis. So strict lending and cheap rates have really led to not a lot of people have to spend a ton of their income to qualify for a mortgage. All right. So total required mortgage payments divided by total disposable income. So the United States, we only spend 3.9% of our income on our mortgage. We'll go back and look at 2008. We were spending 7.2% of our income as a nation on mortgage debt. That's a pretty high number as an entire nation. And what do you know? That wasn't sustainable. All right. So that led to a massive foreclosure crisis and prices decreasing. Now, the next one we're going to see, you're going to see headlines, increase in foreclosure activity of 252%. And that's true. Look at 2021 to 2022. As a nation, there was only 65,000 foreclosures in 2021. That is abnormally low. What do you guys think led to such a low foreclosure rate in 2021?
It was basically outlawed and frozen for a year or so. And the government said, hey, guys,
right? Yeah. And so you go from 2021 to 2022, and you say, holy cow, we gained 100,000 foreclosures. That's a 252% increase. Oh, my God, the market is crashing. We're all going to die. Well, probably not. All right. That 164,000 is less than 10% of the peak of foreclosures back in 2010. All right. So yes, foreclosures might increase because we're going to pick up some of the foreclosures that couldn't occur in 2020 and 2021. But we have a really, really long way to go to get to a crisis like 2008, 9, and 10 proportions.
And you put this in context, like let's go pre-COVID back to 17, 18, 19. Even back then there was way more inventory, at least here in like Denver, like, you know, going to find foreclosures and short sales was about near impossible. I mean, I can maybe think of like one transaction we've done those number of years.
Right.
But it was incredibly hard. And we had, 2 or 3 times inventory probably back then.
And 17, 18, and 19 were pretty good economic years, right?
Oh, yeah.
Well, look at the foreclosures. The important point to remember, there's foreclosures even in good times. There's always individuals that have a bankruptcy, have an illness, have whatever change that leads to a foreclosure. And we're going to see that in 2023 and 2024, but it's not going to be a systemic problem that's going to lead to a crash on the housing market.
We've got some good questions here. Do we want to pause or do we want to?
I got some of our interest rates. We'll definitely get to those during the rates thing. I was going to pause.
I like
any other comments you guys wanted to.
I like Nathan's question, but I think maybe we can wait until we get to the apartment pricing section. Does that sound fair? Sure. Or do we want to address that now? And then Jay's got a great article here. I know where he's leading, but we can wait.
What's the question? I don't see it.
He says, for multifamily, do you see a greater risk of foreclosures given bridge loans with variable rates being taken on them in the past 18 months and rising interest rates?
Multifamily, I would say probably not. And I think it comes back to the same thing that there's a housing shortage.
Are we talking like 1 to 4 units or like 5 plus? Because the debt's so different.
I would say probably 5 plus, right?
Yeah, if you're getting bridge loans, I still don't see a systemic problem because people, larger multifamily, because people still need places to live. Vacancy is super, super low. Now, you might see a risk of foreclosure with bridge loans. I think you're going to see that you're probably not going to cash flow as much because you have to get out of that bridge loan. Interest rates have gone up, and you're probably going to have to put some money into the property to qualify.
Yeah.
But I frankly don't see a systemic problem of foreclosures in multifamily. Chris, what do you think?
I'm going to have to debate you some here.
Yeah, I might have to as well.
Yeah, right? I think I think the like the commercial debt space is going to be, very interesting. Because it's not so much, you're right, people need a place to live. We don't have enough housing for them. Where I've seen it, especially doing being a lot more like the syndications and seeing people putting these bigger deals now, a lot of these people in these good years where you did not have a ton of experience or a ton of money down, bought a bunch of properties, on 3-year, 4-year, 5-year debt terms. And sometimes there was very light value add, or sometimes their pro forma, 7% rent increase. They'll just carry on forever. as those loans are maturing. I know some people are getting pinched on those because the bank's like, hey, in 6 months, your rate adjusts. We need you to put down a deposit $1 million more in an escrow account to help take care of the DSCR coverage, the kind of debt coverage you do on there. And so I've seen some people through my network actually being forced to sell. And I think, Nick, you walked some properties, with Ironton and some the other day. And I think a couple of those were ones they got via seller financing.
They got some fantastic seller, like a couple $100,000 down just from seller carrybacks from the owner that, like one of them was a guy from California that owned 2 properties outright, bit off more than he can chew. It's poorly managed. He's looking to get rid of it, right? But there's an interesting thing. Office, I think, is a segment that's probably in trouble. If you look at a bulk of what's been originated over the last 5 years, if a lot of those operators were to go to refinance their office building, it would be underwater. They would not be able to.
Oh yeah.
So they would have to go and call the capital. Multifamily is actually even broaching that zone where lenders are starting to get nervous. And if we look at like what happened in Houston, the $230 million went into foreclosure. That might be a common thing that we may hear coming up here. They had a 3% interest-only loan and floating rate debt. It went to 8%, and they were 80% loan to value. They were screwed. Their investors lost all their money. Yeah. Now, the one thing that could change things is there's $237 billion of private equity and institutional money waiting to be deployed. So if there's any foreclosure, I can promise you that companies like Ironton Capital or other companies, operators that we're working with, or large institutional funds, they'll be there to sweep up and probably buy them at a discount, which is going to have even more upside. So it depends on what side you want to be on. Operators that are probably going to be a little bit in trouble, as like $1 trillion of debt is set to mature this year and next year. But there's a lot of capital sideline waiting to take advantage.
I think we open a can of worms this question, but like what I'm very curious and nervous to watch is that, and paired with what's going on with liquidity in banks, especially like local and regional banks, since usually local banks hold the debt on this place. They're having liquidity issues. They're having this. It's going to be. I think there's going to be some blood in the streets on there. Yeah, exactly. But the folks that have a good track record and are very well capitalized will be there, I think, to take advantage. And there's a lot of money sidelined. Waiting to be used. And then there's always the wild card that now, who knows, Uncle Sammy may come in and wave their magic wand and say, you know what, we're pausing this, or we're doing this, like they did with the foreclosures. Yeah.
Well, I'm excited by a comment we got here from Jay, who I think this is the Jay that I know. It doesn't show his last name, but it says office is in big trouble. Multifamily will have some issues, but no crash. No single family housing crash. That's his opinion. I agree 100%. I think multifamily, you're going to have a few things like what you described, but I think it's going to mostly be, like Nathan said, some cash-in refinances and maybe some capital calls, but I don't think you're going to see a systemic foreclosure issue in multifamily, because there's going to be too many investors that are going to pick those up before they go to foreclosure.
Yeah, I totally agree.
All right, so let's talk about negative equity and market CLTV. All right, in 2008, 28% of homes had negative equity, meaning they were upside down. All right, so that's that big blue bar graph that you see there. So if you had an adjustable rate back then, because those were popular, and you were upside down and your rate adjusted on your home and you had no way to make those additional payments, guess what happened? That led to a foreclosure. All right. Well, let's go over to the far right, 2022, quarter number 2. We had 0.4% of homes in the United States were upside down. And virtually all of those properties have a 30-year fixed. All right, adjustable rates right now make up less than 1% of the market for single-family homes. We're not talking about commercial right now. But if you've got a 30-year fixed, even if you are upside down, you're generally going to continue to just make the monthly payments. But what happens if there's a 5% price decline, 10%, or even a 15% decline in prices? Well, 3.7% of homes would be upside down. If every one of those homes hit the market for a foreclosure, it still would not even make a dent in the inventory that we need. All right. So a lot of folks think there's a foreclosure boom coming, there's a housing crisis coming. Even if all those homes hit the market today, it would not solve the inventory challenges. And homeowners are sitting on a record amount of equity. If you go back again, look at the left side, where a very high percentage of people were upside down. And as a nation, we were often upside down on equity versus debt for folks that had mortgages. But right now, there's more equity in households than ever in the past. All right. So there's not going to be a gigantic foreclosure crisis.
So on that comment here, a couple questions from the audience here saying, how do you find properties before they go into foreclosure? So, I mean, I would not recommend going out there and buying an expensive course right now on how to find properties in foreclosure, because there will be people wanting to sell you those courses. If you ask the question, it is incredibly tough to go out there and do it. A big part of it is because there's small inventory, and there's a lot of people that are smarter, that have done it before with a lot more money, that are going to pick up that smaller slice of inventory, from my opinion. So like for my investing, I don't focus on finding pre-foreclosures. I think it's too much work.
I will give you the most unpopular answer, and everybody hates this answer, but it's the truth. Networking.
Yeah.
You have to talk to to talk to a ton of people, let them know that you're open for business to buy properties. This is what you're interested in. Of every investment property I've purchased, one I found on the MLS, all the rest was networking. And it's just talking to a lot of people. So foreclosure transactions are out there, but you have to cast a really, really wide net. There's no magic bullet on how to find it.
Yeah, I would agree. And to highlight my comment more, I would definitely always network and say you're looking for it. I would not make the main focus of your business as an investor, realtor, to go out there and find pre-foreclosures.
No.
But network.
Yeah, Jessica has a good point. She says ultimately, because people have so much equity in their property, they'll likely sell it on the open market before going into foreclosure or short sale.
That's right.
Yeah, bingo.
That's exactly right.
So let's talk about interest rates.
Do we have an expert to talk about that?
Let's see.
We might need to go down. We might need to go find someone.
Get the guy off
down the street.
All right.
You threw me off with, So Joe says it jokingly, but Joe's been lending for like 20 years, and he knows this stuff when it comes to lending. So the jokes aside, we have an expert right here. So we got some questions, and Joe, take us through the data.
All right. So let's look at the next slide. So the average 30-year mortgage rate, the highlighted yellow section, we've zoomed into it on the bottom slide there, the bottom portion of the slide. So from 2017 until now, you saw 17, 18, 19, 20 interest rates were really low, never peaking above 5% there in 2019. But below that, you saw the bottom was 2.64 in 2021. And then we had this unprecedented run-up coming out of 2022 with rates going up above 7%. So we had an increase of interest rates of greater than 5% over the course of 12 months. All right. Well, that shocked the market. It shocked a lot of people. It caused some challenges. And then what's happened recently? You've seen rates decrease. As of today, the 30-year fixed average is 6.26. And that everybody's like, oh, it's down from 7%. I feel really good about things. Well, that's true. It is down from 7%, but it's still up from 2021. Now, a lot of people got really addicted to those 2, 3, 4% interest rates. That wasn't real.
Yeah.
That was the abnormal time. All right. Reality that's always occurred outside of the COVID pandemic has always been rates between 4, 7, even as much as 10, 12, 15, 18%. So what's going to happen in the future? Let's go to the next slide. The average over the last 50 years has been an average interest rate of 7.76. It says current 6.32. That was true last week when we put this together. It's now 6.26.
It's a hopeless battle to try to get interest rates and PowerPoint slides.
Absolutely.
Like how much it changes right now.
It's like watching my crypto portfolio throughout 2020 and 2021.
Yeah. So currently, we're still below the 50-year average. We're actually 1.5 points below the 50-year average. And what I think you're going to see is rates flatten and become less volatile over the next 6 to 12 months. But guess what? They're going to bounce around between 6, 6.5, maybe down as low as 5.5. But I firmly believe that the era of 2, 3, 4% is over. If that's what you're waiting for to buy a house, you're going to probably be waiting a long time.
Yeah. And I'm curious, Joe, what your take is on this. I was meeting with a lender the other day, and he was just explaining that the interest rates right now they should be lower than what they're at because they're being artificially inflated by the banks.
So interest rates are based on mortgage-backed securities, but they're tied really closely with the 10-year Treasury yield. And something that we often look at is what is the spread between the average interest rate and the 10-year Treasury yield. And right now, that is higher than it has ever been in the last 50 years. You see that 3.66 on the bottom right there. The 50-year average spread is 1.7%, meaning that interest rates are up by as much as 2% compared to that historical average spread. Now, that doesn't mean that it's being artificially inflated. It's generally being inflated because of risk. Okay. All right. So pricing is based on risk, and what banks and bond traders and mortgage-backed security investors are seeing is there could be some risk.
Yeah.
All right. here's the other important point. Volume is down. How do you make up profit when volume goes down?
Right.
Increase prices.
You have to increase prices.
Yeah.
All right. And that's happening across the board. We're all familiar with inflation. It's happening across the board that things are just simply more expensive. So today,
why rates are not 5.5%? Yeah, why aren't they?
You know, because they don't put me in charge. So from 2020 to 2021, that average spread was 1.79. That spread's now increased upwards of 3% as of when we put this slide together. And if that profit spread or risk spread were to return to normal, rates would be closer to 5.5%. Now, is that going to happen? Maybe, maybe not. Over the last 50 years, yes, we'll eventually get back to that average spread, but it might take a while. And even with that higher spread, the 10-year Treasury would have to go down to less than 1% in order to get back to rates of 2 or 3%. So I don't think you're going to see that happen.
Interesting.
There's a few other rates questions I want to throw at you out
Right.
here too. I think go with the slide. So Mike said, Joe, are you saying the range bound of 5.5 to 6.5 is just a reversion to the mean?
Yeah, I think so. And I think this chart kind of references that. You know, I think rates in a 5.5 to 6.5% rate, that's or 5.5 to 6.5% range is fully appropriate. That is fully appropriate for the strength of our economy right now. And frankly, if you go back and look a few slides ago when rates were at 2-3%, that was way too low for where we were at as an economy. We were supposed to be in that, 4.5 to 5% range.
So as we go through this data on the rates here, and we got about 20 minutes left on the webinar, Joe, Mike asked earlier, he sees tons of forecasts for mortgage rates that are not going to be in mid-5. They'll not be the mid-5s until mid-year or third quarter of 2023. I can't find why anyone will tell me this.
All right. So this is prediction from Fannie Mae, the Mortgage Bankers Association, and the National Association of Realtors. And then on the far right is the average of all three. So they predict that in second quarter, which we're in now, average interest rates will be 6.3%, decreasing into quarter 3 and quarter 4 down to 6.07 and 5.77, and first quarter of 2024, 5.57. Go to the next slide and let's talk about why that is. So the purple line is interest rates over the last 50 years. And highlighted in yellow in gray are recessions, and then highlighted in yellow is improvements in interest rates as you come out of a recession. So every time we've had a recession, one of the things that happens when you come out of the recession is that interest rates improve. And over the last 6 recessions, interest rates have improved on average 2% coming out of a recession. But let's go over to the far right 3 recessions, and you see that interest rates improved 0.6, 1.1, and 1%. You kind of, for this analysis, can't really count on interest rates improving 2 or 3 or 4% like they did in the 80s because interest rates were so high. So why is everyone predicting that rates are going to be down at 5.5? Well, if we're at 6.5 right now, to make the math easy, and coming out of a recession, rates improve over the last 3 recent era recessions, rates improve by 1%. Take the 6.5 we're at now, minus 1% coming out of a recession, you get a 5.5% improvement. And the smart folks at Fannie Mae, Mortgage Bankers Association, and NAR, they all know that. And that's where they're coming up with this prediction for quarter 1 of 2024. How do increasing rates impact the market? All right. There have been 6 times in the past 50 years that we have had a rate shock of greater than 1%. This means interest rates going up greater than 1% in a short period of time. And so what you see is over the last 6 rate shocks, the average interest rate increase has been 1.82%. Well, let's think about this for a second. If interest rates go up, that means that home prices should go down, right?
Theoretically.
That's not what we see. Interest rates have gone up an average of 1.8% over the last 6 rate shocks. We've seen home prices continue to go up 8%. Now the number of home sales goes down by 11%. All right. And let's look at what's happened since December 2021 to November 2022. That's the bottom of the market for interest rates to the peak of the market for interest rates. We saw rates go up by 4%. All right. What has that done to home prices? gone up by 11%. So there's no correlation necessarily between interest rate increases and home price decreases. However, there is a correlation of interest rate increases and the number of transactions decreasing. And that's highlighted in the bottom right corner. We've seen the number of transactions go down by more than 20%. And that is just a function of affordability that we saw earlier.
Sure.
If rates go up, not as many people can afford to buy. So are increased interest rates going to wreck the market? No. Now, if you're a real estate agent, you might say, it's wrecking my market because I'm not closing as many deals as I used to, right? Well, that's probably true, but it's not going to wreck the overall national economy or the Colorado or Texas economy or wherever you might be located. Now, we're also seeing the number of applications for new mortgages is way down from prior years. Also kind of a busy chart. I'll draw your attention to the left-hand chart, the dark blue line at the bottom. This is the number of mortgage applications, which is wildly down from prior years. We're actually on pace with 2014. So think about that. Same number of people applied for a mortgage last week as in the last, as that same week in 2014. All right, that's 9 years ago. Do you think any more people have come of age that they might want to buy a home between now and 9 years ago?
Yeah, a couple of people have.
Yeah, a handful of people, right? Why is it so far down? It's difficult to afford. All right, difficult to afford. How does this impact the market? Well, home prices have stalled. We touched on that earlier, all right? And existing home sales have come way down, which is the slide on the right-hand side. We are not seeing any massive price increases due to these increased interest rates. And the number of home sales is way, way off. Our number of home sales first quarter of 2023 is tracking actually worse than the bottom of the market in 2008. So
What do you mean it's tracking worse?
So see where it is. We're down 37% or 35% right there on the bottom right slide. All right. In 2008, the year-over-year decrease in sales was like 32% from 2007 to 2008. Now, what do you notice? All these little circles that are highlighted in yellow, what do you notice that happens after this fall off in the number of sales?
It goes up.
It goes up. So what do you guys expect might happen as this chart continues over to the right in the future?
Go up.
So do we think that maybe now might be a good time to buy a property?
Yes.
Why do you think so?
Well, for one, there's less buyer competition. I think that's one of the biggest ones.
That's
You
right.
don't have people putting in $50K over asking anymore, and now they're upside down in equity.
That's
you have
right.
people buying maybe at a discount or at what it's actually valued at.
Right.
They're going to be very well positioned, I think, in 3 to 5 years.
Yep. Do we think that interest rates are going to go down to 5.5%? A lot of folks on the slide, NAR, Fannie Mae, Mortgage Bankers Association, they all said yes. Well, when rates go back to 5.5% and people have this memory of rates of 7%, what does that motivate buyers to do?
Buy.
Oh, that's exactly right. I'm going to go out and buy a house because interest rates had improved so much. What's that going to do to this chart? The number of home sales are going to go up. Appreciation is going to go up. Competition is going to go up. And it's important to remember, if you're a buyer or you're an agent out there, more people buy when they feel like it's a good time to buy, but more people get deals when it's not necessarily a good time to buy.
Yeah.
That's such a good thing to highlight. And, this is a very data-heavy presentation. That's great data, but, half it is that emotional or, the art side. This is the science, there's the art, and you nail it how that the psychologicalness of it.
Yeah.
We have about 10 minutes left. I want to answer a 1031 question and the Airbnb stuff. Essentially, the question was, I've heard some rumors that 1031 exchanges might be going away. How will that affect the market? So, for the last 10, 15 years, removing the 1031 transaction. If you guys don't know what that is, that's something that's geared towards investors, not just real estate investors, but also, other investors, other asset classes, where you can sell a property and defer paying capital gains and taxes on there. And it's a huge strategy that people follow to not pay a dollar today, but basically kick the can down the road to this massive, massive tax savings. Well, I remember as I've looked at this in the past, you look at a lot of previous political platforms and budgets. It's been in here for 15 plus years. Let's remove the 1031.
Yeah.
Let's remove the 1031. I am not too worried about it. I don't lose sleep because I think it's one of the few times right now we can say that, people on both parties own real estate.
Yeah, right.
And I don't see the Democrats and Republicans both wanting to eliminate that is kind of like my prediction. So I'm not worried about that. Joe, you've been in this for a long time as well. What's your take?
So I don't love to speculate on what's going to happen with regulation. I like to focus on what are the current regulations, and I'm going to do really well knowing what the rules are, and I'm not going to worry too much about what the rules might be. That being said, I will bet you a cup of coffee that 1031s will be around for the rest of my career.
Yeah.
And if you're watching this recording 20 years from now and 1031s have been outlawed, call me and I'll buy you that cup of coffee.
Yeah, so I agree with the same sentiment. And, keep in mind that no matter what, the market always adapts, investors always adapt, lenders, realtors, everyone always adapts. But everything going on, that is about the bottom of my list to be worried about right now as a realtor or as an investor. All right, let's talk about short-term rentals because this is, a question that we get a lot. And for many markets like Denver or Denver Metro, this is one of the few strategies that actually can really cash flow well. So what's going on in the short-term rental market?
So I'm seeing a lot of my clients purchase properties to use as short-term rentals, and I think they're going to find out that supply is growing faster than demand.
Yeah.
So you have to remember a short-term rental, you're basically buying a mini hotel.
Yes.
Okay. And when you're buying a long-term rental property, you're buying an investment property, you're putting somebody in there that's going to use it for workforce housing, right? They're living there, they're going to work every single day. You're buying a short-term rental, you're buying a mini hotel. Now, there's a word that's been floating around a lot in the news lately, starts with I. Anybody heard of inflation?
What's that?
All right. When inflation goes up, what is the first thing that gets cut out of people's budgets?
Travel.
Travel is probably
Luxuries,
one of them,
right? Luxuries, like travel. All right. So if travel's getting cut, that means there's going to be fewer nights of people staying in hotels, fewer nights of people staying in short-term rentals. I would personally be a little worried about going into that market, knowing that demand is going down because people can't afford it. All right. Now, that doesn't mean it's necessarily bad because there's opportunities in all markets, but I think you're seeing that supply, there's more people buying short-term rentals than there are people looking to occupy short-term rentals. And that's what we got here. Occupancy is most likely going to decline around 2%. Now, that's not a massive number, and it's probably going to get some modest gains, and it's probably going to outperform, stats prior to COVID. But personally, I don't invest in short-term rentals because I don't like going into a market that I don't fully understand, like travel and luxury.
Yeah.
That's outside my scope of expertise.
Yeah.
And this shows that short-term rental supply is at record levels. All right. So for me personally, I would not go into that because we know that inflation is impacting travel. But I say that because I look at all the charts and stats, yet every time I go to the airport, it is packed. So anecdotally, maybe it's still a good thing. But I think all the numbers show that we're going to see a lot more supply and a lot less demand.
Yeah, I agree. And I don't think it's going to be nothing's going to crash, right. Shouldn't be like, oh my gosh, things are flattening or slowing down. I shouldn't buy a short-term rental. I think it just, in my mind, it's like, hey, that the party of it, the fast increases in rates we've seen and like some of the big numbers, I think that party is over.
Yeah.
As trends have changed with inflation, as more people have bought Airbnbs, they've become a very popular strategy last couple of years and more people are putting money into it. My biggest thing here is, make sure you understand it, but make sure you have a plan B. Not just because of occupancy changes, but also in case your local regulation changes as well. Like Denver Metro is made up of 5 counties, and Denver County, I think 3 years ago, Joe, basically banned short-term rentals unless it was an owner-occupant house. Like, meaning you lived there, it was your primary residence, and you were renting out a room or the basement suite or something. Otherwise, you cannot have an investment Airbnb. And now a lot of investors kind of got caught with that, where they're like, dozen Airbnbs making cash, and then the regulations changed, and they either have to pivot or the city slapped them on the hand and said, hey, you can't do this anymore. But they changed one of their. So always have a plan B.
Yeah.
Yep.
And I suggest looking at a medium-term rental if it makes sense, or hey, worst case, a long-term rental. Hey, have a plan B, have a plan C, because they can be great cash flows, but based on what's going on in the market and local regulations, it could change on you.
I think that's a good point. Absolutely. If you're underwriting your own deal and you're looking to, I want to do this as a short-term rental, underwrite it if it were to be a medium-term or a long-term rental, because that way everything else is just a cherry on top. You can fall back to plan C, and you don't need to sell your house. You're not over-leveraged. You're still in a fine position to be able to rent it out, and adhere to regulations. So I think I think you made a good point, Chris, and I think that's how everybody should be looking at.
I think some of the multifamily investors from like 20 minutes ago should have taken that same advice.
Yeah,
right.
Exactly.
They didn't. They were too optimistic.
Yeah,
and that's what you don't want to do, especially if you're investing your own money on 1 or 2 properties. You want to be very pessimistic in your initial underwriting.
Yeah. Mm-hmm. Well, and on that note too, it's clear that the banks aren't necessarily thinking about that because they allow these guys to come in at max leverage because the lending's loose. They're like, oh yeah, the pro forma looks great. 2 years from now, yeah, this will be a great property. And then all of a sudden something like this happens and now they've got no capital to deploy into the project and they're left holding the bag.
That's right.
So here's a good comment from, I see the I now, so it's Cal, not Kai. So thank you, Cal. Short-term rental to medium-term rental is something that he's pivoting to with one of their urban properties as well. So I see that trend going on. And we have time for about 2 minutes left. So I want to give a couple quick shout outs and answer one last question on here. Make sure to highlight Joe as a big thank you. I don't have a slide for you in here, Joe, but I think your website is loansbyjmassey.com.
Yep.
Joe is investor himself, been lending for years, used to commercial, knows the market, helped me out buy a bunch of properties, help clients. If you guys ever need help with lending, definitely reach out to Joe and talk to him and his team.
Thank you.
Great resource for data and just gets the job done with lending, which we always appreciate. Another big shout out, big thank you to Iron and Capital, which is, I'm with here and so is Zach and Nick. And this is one of Lon Walsh's new businesses on helping people invest passively. So rather than owning a rental property directly, you're basically owning a small share in a bigger project. So it's a completely different type of modeling or investing, a lot for accredited investors. But a big thank you for Lon and Iron and Capital for sponsoring this webinar and providing lots of good data. What predictions do you have on the number of new builds going forward? 14 years of deficits need to be made up with builders incentivized. Lon, I think you're on. Do you want to answer this one?
I don't know if there's going to be any incentives being offered to them, regrettably, but, we were seeing that the number of new builds has been increasing a little bit every year, and it's been getting kind of close to the historical average of about 1 million units a year. So hopefully we'll continue at that pace.
Yeah, I don't think there's going to be any incentives. And frankly, the big challenge for new builds is cost of water, regulation, cost of labor, and cost of materials. So I don't think we're going to see any type of entry-level product being built. It's going to be, high-end, luxury, above average pricing. So I don't know how we're going to make up that $4.5 million deficit. That's a big deal.
You look at a lot of the bigger things. Build to rent. Has been going on for a couple of years, where basically people are building like horizontal apartment buildings versus vertical. Rather than building 100 units, they're building 50 duplexes and basically making like a single family apartment kind of rent. So I think we've seen tons of money flow through that way.
Yeah.
I know Ironton's in a couple of those deals, and from like the macro, just like tons of money for the industry have flown into there. We're going to have more of those products, and I think we're going to become a country of a lot more renters.
Yep. I think so too.
Good or worse, I think it's going to go to, we have a lot more renters out there because people can't afford it. There's no inventory to buy.
Yep.
So everyone, thank you so much. We got to wrap up here. It's coming up in the hour. Joe, thank you for coming here and helping to give us some context. Zach and Nick, thank you guys as always for helping out with questions and insights. Everyone on the webinar, we'll send out the recording. We'll send out resources. If you have other questions for Real Estate Investing in General for Colorado or national stuff, reach out to us. We got lots of resources for lending, brokerage, buying properties, investing. We're happy to either help you out, or a lot of times we can tell you who to talk to and play matchmaker. So everyone, thank you so much, and we will see you next month for the May's National Trends.
Thanks, guys.
See you guys. Everyone.
Bye.
Thanks, everybody.